Okay, our program today, our speaker is Marvin Appel. He's a well-known speaker, does the AAII conferences, speaks all over the country. He supplies inputs to CNBC, CNN, Financial News Network, and Market Watch. And I really appreciated the fact that he was willing to arrive early and speak to a technical analysis group. Very nice presentation there. So that's really nice to have speakers because he gave a different talk than the ones he's providing today. He is the publisher and manager of investment newsletter, Singular. Is that how you say that? Singular, yeah. Systems and Forecast. And it's interesting that I started investing in 1973. So that's when the newsletter, which put out by Gerald Appel, who was the originator of the MAC indicator and has been around. And by the way, there are not very many newsletters that have been published continuously over that time period. And the other point is Marvin manages money. And we have many speakers who they deal with the theory of it or they send out notices about it. But you know what? Managing money is not easy. And you folks manage your own money to some degree or completely. And that's a difficult thing to do. So Marvin talks about it. He's actually handling money, clients, and working with them and making investment decisions. And I think that provides an extra insight. Anyway, we're going to be talking about high income in turbulent times. And income is a very important subject for our investors, because many of you are retired or going into retirement. So let's give a warm welcome to Marvin, and we'll get the first of his two presentations. And if you have questions, raise your hand. I'll bring you the mic. Then everybody can hear it, including the people remotely.
Okay. Is this working? Oh, good. Thanks. All right. Well, thank you very much for coming out on Saturday morning and having me here. I always enjoy any excuse to visit California. I'm going to be talking about some strategies for the first half of my talk. I'm going to talk about strategies that you all can do for yourselves to earn income in what is a very meager interest rate environment. A couple of details. Out in the registration table, I left some brochures about my money management business, which is my day job, managing money for individual clients with an emphasis on risk management. So that we've been able to avoid the brunt of every major market decline since my dad started the business in '73. The other thing I left there is some questionnaires. If you'd be kind enough to fill them out and either hand them back to me or leave them at the table and back so I can know how to make these presentations more useful in the future. I don't know if you noticed, I have an MD and a Ph.D. I'm actually a board-certified anesthesiologist, and now I put people to sleep in investment conferences. This is a career change back in 1996. So I've been doing this for a while. Next slide, please. So I'm going to start reviewing the interest rate landscape, and then I'm going to mention fixed income strategies for earning higher yields, the main one of which is going to be trading open-end high-yield corporate bond mutual funds and floating rate funds. And then I'm going to close with a discussion of, I'm going to give you some recommendations for some preferred stock issues to keep an eye on. And then I'm going to close with a discussion on covered call writing, which is a potential income-generating, a popular income-generating strategy, but I'll show you how to recognize when it's more promising than at other times. This is a chart of 10-year Treasury note yields from 1962 until recently, and the point is you can see that we are at really low yields, right, in the 1.6% level. I think you have to go back to the early to mid 1950s to find a time when yields were even close to that. The record low was in 2016, at the 1.37. So we are hovering around historical lows in interest rates. And this is a problem because, especially if you're retiring soon or in retirement, low volatility is an important investment attribute. It's fine when you're 25 or 35 and you're building your money and you have 30 more years of working ahead of you or 40 more years of working ahead of you that you can ride out the market volatility. But if you're retiring and volatility hits at the wrong time, it can be a problem. So here's the standard rule of thumb for withdrawing in retirement is 4% of assets per year of your initial nest egg. So if you retired with $1 million, you could take out $40,000 in your first year, and then every year you increase that to keep up with inflation. And that's based on research by a gentleman named Bengen who did it in the mid-1990s on a 60% stock, 40% bond portfolio. And he just looked historically, if you did that, what was the withdrawal rate that no matter what had happened historically, you could have lasted for 30 years with your money. So here's just an example. If you had retired near the market bottom, right? You retired at the end of 2002, and you took out your 4%. Well, you can see that the 60-40 bond portfolio did great, right? I mean, between 2002 and now, if you were just buying and holding your portfolio, even at 40% bonds, nearly, more than double, well above double. But if you were withdrawing 4%, you're actually barely, it's been a very good market climate for the last 11 years, so you're actually ahead of where you retired, but you went for a very long time. A lot of the first 11 or 12 years of your retirement, you would have been underwater. And even though it worked out fine, you don't know that prospectively. There's no guarantee for the future, and so you might have been nervous. But what if instead of retiring in 2002, you retired in 2000? Well, that would have been a disaster, right? So you would have started here, and even though again, the stock market from the end of the stock bond portfolio from the end of '99 from now would have doubled, your purchasing, this is purchasing power, so it's adjusted for inflation. Your purchasing power never got above half where you retired if you happen to retire at a really bad time. So that's the danger of retiring with a high volatility portfolio. And so our approach for clients and the approaches I'm going to show you are about how to manage that volatility and recognize the major market trends so that even if you're choosing just exactly the wrong time to retire or the wrong time to invest your money in one of these strategies, at least you have some limit on the amount of damage that you're going to incur before things turn right. So the main strategy I'm going to talk about, and this is my favorite strategy for clients, has been for many years, is trading open-end corporate high-yield bond mutual funds. This is doesn't work as well for ETFs, doesn't work for closed-end funds, doesn't work for individual bonds. It's for open-end bond mutual funds. Now, corporate high-yield bond funds are my favorite asset class, and the reason is because on a risk-adjusted basis, they've just beaten everything else. This is the last 20 years of history. I apologize if the lighting doesn't allow you to see it, but basically over a 20-year period, the high-yield bond benchmark made 6.6% a year with a worse drawdown, that's a percentage loss from the peak to a subsequent valley, of 35%. So that's if you've been buying and holding high-yield bonds for the past 20 years, you would have made potentially 6.6% a year, worse loss, a little more than a third of your money. The consumer staples sector spider, that's defensive companies. These are a lot of food, consumer products, drinks, things like that. Procter & Gamble is the biggest one. These are companies whose earnings hold up and sales hold up relatively better during recessions than the overall market. They're low budget things that people tend to not cut back too much on, even if the economy turns soft. That made 5.8% a year with a 36% worse loss. So on a risk-adjusted basis, that's actually that's good.
Question: do you happen to know what the S&P utility sector is?
I don't know off the top of my head. My guess is it's similar to what the S&P did. Utilities as a long-term investment have basically kept match with the market over the long term. Over any given period, it'll outperform. But I think the drawdown was right. S&P 500 itself during this period made 5.9% a year and had a worse peak-to-valley loss of 55% based on daily data. And that, of course, that actually occurred twice, once when the tech bubble burst and once in 2007 to 2009. So even on a buy and hold basis, high yield bond funds have been a good investment for a long period of time. This chart shows compounded growth on a linear scale of investment grade bonds versus corporate high yield bonds. The red line is investment grade bonds. This goes back 33 years, and investment grade bonds would have made 5.8% a year, which is very attractive given today's interest rates. Because right now, if you buy the Vanguard investment grade bond index fund, you're looking at an interest rate of about 2, maybe 2.2% a year. So if interest rates stay flat, that's your expected return, not 5.8. So whenever you look at a history of how did bonds do, just remember that the multi-decade history cover periods when interest rates were much higher than they are now. Therefore, bonds are much more profitable than they're likely going to be. High yield corporate bond funds made an average of 6.9%. But again, there are risks in buying and holding these. So I would never recommend buying and holding a high yield bond fund because if you're 89, 90, you had a 25% decline. That was when Michael Milken was getting run out, getting put in jail, and Jessica Brennan Lambert, which had been a big market maker for high yield, going bankrupt. Then you had a period of several years from late 98 to 2002 when high yield bonds did nothing. In the financial crisis, high yield bonds, as we said, lost about a third of their value. And in 2015, 2016, because mainly of woes in the energy sector, which is a big issue of high yield bonds, we had a big correction there too. So high yield bonds have their corrections, and I think they're too risky for your typical safety-minded bond investor to buy and hold. But I'm going to show you how you can profit potentially from these and their better yields. Instead of the 2% you get from investment grade bond funds or investment grade bonds, you can get maybe 5% in interest income from high yield. And I'll show you how to manage the risk in the event of another one of these big bear markets in high yield bonds that has arisen every 2 years. And the way you do that is with buy and sell stock. So you track each individual high yield bond fund that you own, and you set your buy and sell stops for each fund separately. You have to check the total return of your fund at least monthly. Weekly is probably best. Monthly is still good. Daily actually probably is better than weekly, but less than monthly, it won't work. There'll be too much decline that can happen before you actually get out. So monthly or weekly, you should check your high yield bond portfolio, taking into account the return that you get from interest distributions as well as from the price. And the way a sell stop works is that you look at the last peak. Let's say you're in the fund, and it falls by 3% or more. That triggers your decision to sell. So 3% decline or more from the last peak, you sell from the fund into cash at the first opportunity that there's that 3% decline. I've drawn it here to happen in one time period. It doesn't have to happen in one time period. It can evolve over a period of several periods. It can happen all at once. Whenever the first print you get that the value of your bond portfolio, your high yield bond fund, including the interest received, is 3% below its last peak, then you sell. The rationale for that is that historically, high yield bond funds move in trends that last weeks or months and usually several percent. So once they start to move 3% in each direction, they've had a tendency, at least a favorably significant tendency, to continue in that direction. So if things go as you theorize, fund falls 3% from its peak to sell, continues lower. This is the fund, but your equity curve, your account is flat to intact. Continues to until it hits some kind of bottom. So you're not in the business of needing to predict when the bottom has occurred, or you have to recognize it at the time. You recognize the tops and the bottoms after the fact, the potential tops and bottoms after the fact. When it bounces 3% off of its last low since it's sold, that's the signal to get back in. And the rationale is once they've advanced 3% off of the low, they've had a tendency to continue in that direction for a long time to come. So if that happens, you get the bounce. Now the fund recovers, which you hope it does. Your account grows. Hits some kind of peak. Again, you don't have to anticipate. When it pulls back 3% of that peak again, your next sell signal. So those are the 3% buy and sell stock. Using this kind of method, you're going to be invested in these high yield bond funds about 75 to 80% of the time. And most of the time, the market climate is favorable for corporate high yield bonds. It certainly was favorable for virtually all of last year, and even though they're off to a bit of a bumpy start this year, nowhere near a 3% kind of space. So we're still on a buy signal for these funds. I tracked several of them in my newsletter. So if you wanted to get the get the signal calculated for you, you could do it that way. But you can easily do this yourself. So here's some examples with a couple of real funds. This blue one is Ivy High Income Fund. It's one of the more volatile high yield bond funds. So they have junkier junk and higher yield than average and more volatility. So in 2015, 2016, there was a big correction in high yield bonds. This fund looks like itself was at 6.2 to 5.4. So we're talking about well over 10% correction. So here, 3% from the top, you would have gotten to sell, would have bounced 3% from the bottom in early 2016, you would have gotten in. And then you would have stayed invested in this fund until October 2018 when you got to sell. There was a correction. There was a rapid bounce. You would have gotten back in very early in 2018, and you'd still be invested. Here's a quieter fund, the TPW high yield, the orange fund. This one, you got the 3% pullback in late 2015. Never went much below that. You got a bounce in early 2016. So this trade probably didn't do you any good. And then you've been in, basically you've been invested in this fund for the last 3 years. That's why it's important for this kind of method to use it stops for each fund. Yes.
Question. For mutual funds, not all brokerage firms will. Everybody will trade them, but some of them have fees, which now you don't have to pay for ETFs and stocks on trading mutual funds. But they have some funds will trade no fees. If you buy a Fidelity fund in Fidelity, there's no fee to trade. On the other hand, so where do you get these funds and not have to worry about fees to trade it?
Okay. Well, let's see. We have the largest fraction of our client assets managed in Ameritrade, and they have a large platform of funds that at least we as advisors can trade for no fee. And so that's been great for our clients. Unfortunately, they merged with Schwab, and Schwab doesn't have a similar thing. So this system is only going to trade on average maybe 2-3 transactions a year max. So if you're at a discount brokerage like Schwab, even if you have to pay the $10 or whatever the fee is to trade it, it's still worth it. You have to evaluate that yourself. You also have to be mindful that some funds don't like people bouncing in and out of them. So even though the system most of the time holds for extended periods of time in a month, sometimes, especially if you're checking your results weekly, you can get out and back in or in and back out in the space of under a month, and the funds don't like that. So if you're going to do this, as they say, we track 3 funds on the newsletter, but basically find corporate high yield bond funds. Make sure you check the prospectus. Make sure you're not buying a load fund. There's no point in a load to get in and then getting out. So you have to do no load fund. And in our practice for clients is even if we get a sell signal, we hold our funds for a minimum of a month. That's a discipline that's probably useful for you guys to do on your own accounts, then you won't draw on to the pension. But I want to say for our clients at Schwab, we pay the fee of $10, and it still works. Here's an example. This is not the 3% stop system. This is our own high-yield bond model that we use for clients, based in the same theory. It's a trend-following system. We don't try to anticipate when turning points are going to occur. We just react to them after they've occurred, but in a timely manner. So from 1988 to 2013, this is an old slide, our model would have gained 10.5% a year with a worst peak-to-valley loss of 12%, compared to buying and holding, which during this period of time would have made 7.6% a year and the worst peak-to-valley loss of over a third. Here's an updated, this is our updated client model and updated results. So for the last 12 years, trading high-yield bond funds would have made 11.4% a year, with a worst drawdown during this period of only 7%, again, compared to buying and holding, which was made much less, still a respectable 0.8% a year, but still have that one-third drawdown. One thing I want to point out, any kind of bond strategy you do, whether it's this one, whether it's what we do for clients, whether it's your own strategy, you're going to make more money when interest rates are high than if they're low. And so this type of bond strategy works really well after a market crash. So here, for example, in 2008, we had this big loss in high-yield bond funds. You can see by the flat line in the equity curve that the model was out during that time. Then when they rebound from a period of time after prices decline, which means interest rates have risen, you get supercharged results. So in 2009, that was really the banner year for high-yield bond funds. Then in 2016, there was a big decline here, 2016, early 2016. Then the model was out of that. You had a supercharged year for 2016, starting at low prices, high yield. So this is not the kind of thing where you can say, okay, I'm going to make 6% a year in and year out consistently. It's still variable from one year to the next. The important thing is that during the major declines, like this, 2015, 2016, 2008, you're protected, at least partially or mostly. And then when the market recovers, then you're in a position for above average return. Right now, of course, I'll get a little more into this, but of course, interest rates even for high-yield bonds are on the low side by historical standards. It means going forward, you don't expect 11% return. The S&P yield on these funds is 5% range, 5.5%. That's the return you expect from any bond. You look at the S&P yield, that's the interest income after the fund expenses, and that tells you what the return is if interest rates stay flat. Yes.
Okay, when the model says get out, what do you get into? You get into a money market, get into something else?
Oh, good question. Generally, I mean, for the purposes of these track records, we didn't count money market interest. Generally, you get into money market. There is something to be said about the possibility of getting into intermediate term treasury, but doing so will slightly improve the return, but will also increase the risk. So for our practice, we get into money markets. Of course, now the yield curve is relatively flat, so there's not a huge advantage in terms of interest income being in a money market versus treasury money market versus being in an ETF like IEF that's 7% treasury. So when we do this to clients, and what I'd recommend to you, generally speaking, is to be in money market. That said, in 2008, if you bought intermediate term treasuries, you would have really supercharged returns that year, but that's not a reason. Okay, yeah.
Question: in this, looking backwards, where we really had a long-term sort of secular decline in interest rates, you mentioned that most of the time you're long this because interest rates are going down, the prices are going up. If that ever turns and we get a long-term increase in interest rates where the prices are going down, you're not going to be in this for her.
Okay, you raise an important point, but it's not as bad as you said. One of the things I like about high-yield bonds, because every now and then, I mean, it's common for people to say, well, interest rates are low, what if they go up? The answer is that high-yield bonds, corporate high-yield bonds, are less sensitive to prevailing interest rates than regular bonds. So when we talk about interest rates, we're talking about investment-grade interest rates or treasury, intermediate treasuries, like the 10-year yield. So what would happen if the 10-year treasury yield were to go up? It would be a bit of a headwind for these corporate high-yield bonds, but they hold up much better during periods of rising interest rates, rising treasury yields, than does the investment-grade bond market or the treasury market itself. And the reason is, think about what kind of economic climate generates rising treasury yields, rising investment-grade interest rates. It's an environment of inflation or strong economic growth. And that kind of environment means that these high-yield borrowers that have relatively heavy debt burdens have more pricing power, are more likely to be able to service their debt. So, you do have a rise in treasury yields is a headwind to bond prices, but at least with high-yield bonds, the countervailing tailwind is that in that kind of environment, the underlying companies have become more creditworthy. So the prices get support from that. So if you're concerned about, well, what if we're in a low interest rate, we're going to go into a rising interest rate, which I don't particularly predict, I wouldn't mind it happening for just this reason. But if you think we might be headed into a rising interest a regime of long-term trend in rising interest rates, high-yield bonds are the place to be. They hold their value better during that kind of time. But the other thing I'll say, though, is that the whole purpose of this kind of method is you don't have to have a crystal ball. Again, if this is exactly the wrong time to invest in bonds at all, because interest rates are destined to rise, well, then fine. This method at least will cut your losses. Okay. Now, a cousin to high-yield bond funds are floating rate bonds. And these are bank loans made to junk bond borrowers, so they're saying below investment grade borrowers, bottom 1/6 of the corporate bond market. Again, generally, it's well over $1 trillion. The floating rate in the corporate bond, junk bond market have really expanded. But these are adjustable rates. So even though it's the same credit quality borrower, the rate resets every 3 months. And this is pegged to the prime rate, which is goes in line with the Fed funds rate. So while most bonds deal with intermediate term rate benchmarks like the 10-year Treasury or 7-year Treasury, something like this, if you want to know what the interest rate story on these is, you have to look at the Fed funds rate. The prime rate is parallel to that. Now, historically, since these originated as bank loans, these are better collateralized than high-yield bonds. So that means that historically you had better recoveries when the company go bankrupt. Remember, if a borrower goes bankrupt, it doesn't mean the bondholder gets zero. Usually there's some recovery. For high-yield bonds, it's an average of 6% of the dollar. Varies widely. If it's during a recession and everyone's defaulting, the recoveries are lower. And if it's an isolated bankruptcy case when otherwise things are booming, the recovery might be higher. These have historically had a even better recovery rate. These are great for when the Fed is raising rates. So in 2018, we made a larger than usual bet on floating rate bonds because the Fed was telegraphing that it was going to be raising rates directly. And every time they raised rates at 0.25%, the yield on these floating rate funds went up at 0.25%, while the yield on high yield corporate bond funds wouldn't be affected by that. It'd be affected only by market fluctuation. And so floating rate funds are one of the very few asset classes that even on a buy and hold basis were profitable in 2018. You have to be wary of potential liquidity problems. It's a much larger market than it used to be when we started using these more than 15 years ago for our clients. But what that means is make sure you buy a fund that won't restrict your exit, and make sure you understand the holding period that the fund's required. When we started using this, there was a fund by Oppenheimer that would only redeem quarterly, and if more people wanted out at the end of the quarter than they were prepared to redeem, then everyone would get their redemption honored on a proportional basis. So that's the kind of fund you don't want to be in, because you don't want to be buying holding. So these funds are quieter than corporate high yield bond funds, and historically safer. Historically safer. They don't yield as much historically. So here's an example. The blue line is Hartford floating rate. Hartford floating rate fund, which is one of the more volatile floating rate funds. And the orange line is Lord Abbett High Yield, which is a average corporate high yield fund. And you can see 2015 to 2016, the orange line, high yield fund, it started higher and fell further than the floating rate fund. And then during the recovery, the high yield fund, of course, bounced more, returned more. But actually in 2018, the last quarter, you had a bit of a correction here for the high yield fund. You had none for the floating rate. So it's a good idea if you're going to dabble in, if you're going to use these for your portfolios. In general, you should entertain using both of them, diversify a little bit. Okay, is this better? Here's an example of trading floating rate funds on the 3% stop system. Again, this is the Hartford floating rate buying and holding for the last 13 years. You would have made almost 4% a year with a 32% drawdown in the financial crisis. Trading on the stop, you would have increased your return to 5.6% a year with the worst drawdown of only 9% worst loss, because you added this decline and out of the 2015, out of part of the 2015-2016 decline. So what's the outlook for trading high yield bonds going forward? Again, the problem is that it all depends on interest rates. So this is a chart going back to 2013 of the difference between junk bond yields and Treasury yields. And that spread, that difference is the amount that the borrowers are getting paid to assume the credit risk of high-yield bonds. So the wider the spread, the more generously you, the investor, are getting paid for lending money to riskier borrowers. And you can see that this was like a low. There was a slightly lower spread in the late 90s, although baseline interest rates were much higher. But you can see that the lower the spread, the riskier the greater the risk of an unpleasant surprise. And we got recently at the start of this year, we were retouching historical lows in spread. So that's the problem. I mean, the time to buy high yields is after the spread gets wider, 5% or more, and then starts to go down. I mean, that's what the system will get you. Is you get that 3% bounce off the bottom. That if you can get that buy signal after prices have fallen, after spreads are widened, that's where the great buying opportunity is. So early 2019 was a great buying opportunity. Early 2016 was an even better buying opportunity, and early 2009, which isn't on this chart, was even better still. So right now we're starting with low interest rates and relatively tight spreads. The good news for you, if you haven't started this strategy yet, is we recently had a blip in yield. So now the difference between the yield on the high yield benchmark and treasuries at comparable maturity is 4%. And you can see by the standards of the last few years, that's still not a super bargain, but it's a lot better than 3%. It's better than we've been. It was better than we were for most of 2017 and 2008. So it's again, it's not a screaming bargain, but it's not a terrible time to get started. So the outlook for the sector, well, debt, corporate debt as a share of GDP, as a share of the economy, is at a record high, higher than at the peak of before the financial crisis, higher than the peak before the tech bubble, higher than the peak before the 1990 recession, the other major bear market. And the market doesn't really care. Right? Spreads, as we saw, are still tight. So that's not good. Corporate debt burdens are climbing faster than profits. So this is the default rate, and this is the debt as percent of profit. So the good news here is that even though the dollar volume of debt is huge, record levels and record levels compared to the economy, the actual profits are also huge, and so the corporate burden of debt compared to corporate profits is not as high as it was in the previous major peaks. So that's good news. The default rate started to tick up a little bit, but you can see it's still at low levels. The average historical default rate is about 5% for high yield. So 5% of high yield borrowers default in any given year. But there are very few average years. What happens is there are big bunches of defaults in and around recessions and very small numbers of defaults during normal times. So here again we see this is the European Union and U.S. high yield default rates starting to tick up a little bit, but still low. So it's a mixed picture for high yield bonds. You're not being richly rewarded with interest rates. On the other hand, default rates are low, and debt burdens, because interest rates are so low, are also very reasonable. Here's another slide showing the reasonableness of debt burden. So again, even though the dollars in debt is large in absolute terms in the share of the economy, as a share of corporate assets, it's much lower than it was at the previous junk bond market peak. The other issue that I like to follow is the Treasury market. This is the break-even inflation. So is everyone here familiar with Treasury inflation protected securities? Okay, yeah. So they basically pay some interest rate plus whatever inflation. So if you want to invest your money for 10 years at no risk, you could buy a 10-year Treasury bond that'll pay you whatever inflation is over the next 10 years. You don't know what that is, plus a fixed rate, which is something like 0.25% nowadays. Or you could buy a regular, what they call nominal 10-year Treasury, which right now would get you 1.6% a year. So the difference between those two yields is the amount of inflation that has to occur in the next 10 years to make the return from the two bonds equal. So it's the amount of inflation that the Treasury market is implicitly forecasting is going to occur in the next 10 years. The more optimistic Treasury bond traders are about the economy, the higher the rate of inflation they expect over the next 10 years. So when that rate of inflation, when the break-even rate of inflation is rising, that's a sign of increasing economic bullishness. and when it's falling, it's a sign of economic caution. All right? So you can see here we had a peak in 2018 before the fourth quarter, and it's been in a pretty steady downtrend until the middle of last year. Then it was rising in the last half of last year, and then this year, since the start of the year. So before the coronavirus hit the news, the Treasury market was signaling increasing caution. So it's very much a mixed picture. Okay, we have default rates on junk bonds slightly ticking up, but still low. And by the way, don't trade your high yield bonds based on the default. That's a lagging indicator. The prices will move before the default rate. So the default rate is just starting to pick up. That doesn't, I mean, it'd be bad if it were a lot higher, I suppose, while prices were still at current levels, but you can't really use that for your trading. The Treasury market is signaling caution. We're still not at a kind of a bubble situation because debt burdens are not as high as they were at previous peaks. So it's an uncertain outlook. My outlook for this year on high yield bonds is for modest returns in the 5% range, commensurate with what the yields are. And that's why it's important to have a fail-safe method to tell you when to get out. As far as floating rates are concerned, the next decline could be dangerous. There's been a real hunger for yield, and as a result, floating rate borrowers have been able to demand relief from the usual bank rules about how they have what are called covenants, about how much earnings or sales they have to generate or asset coverage for their debt. If they violate those covenants, traditionally the bank would call the loan in immediately before things get worse, and that's a protection for you, the bondholder. But over the last few years, the banks have had to, because of it's when it comes to debt, it's been a seller's market. Banks have had to loosen their grips on the borrowers, and so the next recession, whenever it occurs, again, it doesn't look like that's happening anytime soon, judging from what the markets are doing. But when the next recession occurs, it's going to be a doozy for floating rate bond funds. So again, it's important to have an eye on the exit. All right, so that's how you use. That's a simple trading method you can use: 3% buy and sell stocks to limit your risk. Because again, none of us have a crystal ball. We don't. I have my outlook, but if I'm wrong, if the market does something completely different from what I expect, at least I can keep my clients on the right side of the major trend because I have a system that's objective, it's quantitative, it's not foolproof, as nothing is, and nothing is guaranteed for the future. But at least you have a simple system here that will keep you potentially on the right side of major trends, and so you don't have to be right. You don't have to, even if you're buying at what turns out to be the wrong time, your risk is limited. If things turn out better than you would have rationally expected based on how low interest rates are, this gives you the serenity to get in and profit from it if that's what's coming down the pipe. But now I'm going to recommend to you a couple of preferred stocks, and it's a very different strategy. So when it comes to high yield bond funds, you want to be in line, or floating rate bond funds, you want to be in line with the market's trend. When it comes to preferred stocks, if you buy one, you should consider yourself married. Right, because there's no similar simple trading system that I've ever been able to find that will allow you to mitigate the risk of owning a preferred stock while participating in the trend. A preferred stock is basically it's a debt security, but you're in line ahead of the common shareholders for dividends and in line behind the bondholders. So, but most preferred stocks are issued with 5 years. Initial 5 years, and then after that they can be callable at any time. So like a mortgage-backed security, if interest rates rise and you own a preferred stock, you're stuck with the losses of holding a very long-term bond. Rates are rising. But if interest rates fall and you hold a preferred stock, after 5 years you'll get your shares called. So your participation as a holder, you're on the upside, you're not going to be behaving like a holder of a long-term bond. Your investment is going to behave like a shorter-term bond. So because of this, and because they're in line behind bondholders, preferred stocks pay among the highest yields that are available in the market. Now, the two preferred stocks I'm going to recommend are issued by companies called mortgage REITs. A mortgage REIT is a real estate investment trust taxed like a REIT, which means that the company pays no corporate income tax. It has to distribute at least 90% of its profit as dividends, and those dividends are taxed as ordinary income. But mortgage REITs are a particular niche in the REIT industry. Instead of owning properties, they take shareholders' equity, they leverage it up by short-term borrowing 5 to 8 times, and they use that leveraged pool of money to buy mortgage-backed securities. Now, as with preferred stocks, mortgages are generally callable, or not not callable, I guess they're puttable by the person who borrows. So that if you own a mortgage, when you buy it, when you lend out to someone for their mortgage, where rates are now is the best possible outcome you can have. If rates fall, the mortgage borrower is going to refinance, and you, the mortgage lender, are stuck with reinvesting your money at a lower interest rate. And if rates rise, you're in the bad position of basically having bought a bond, long-term bond at an interest rate, and had rates rise again. But as with preferred stocks, because mortgages can be refinanced at the borrower's option, the mortgage-backed lender, gets hurt no matter which way interest rates move. And the mortgage REITs compound that risk by several fold by leverage. So the good mortgage REITs are the ones that can figure out how to manage that risk by hedging whatever they do. I like the preferred stocks in the mortgage REITs. The common stocks yield more, usually over 10%, but common stock dividends get cut because the profit for the mortgage REIT is the difference between their leverage cost, whatever short-term borrowing rates are, and what they can get lending out by buying mortgage-backed securities. That interest rate spread is their profit. And we're in a relatively flat yield environment right now, so it's not great for the common stocks. And when the spread changes adversely, the mortgage REITs have to cut their dividends. But they can't cut the preferred dividend. So the preferred is safer than the common, even though it yields less. And I think that's very important. So that's why I recommend preferred stocks in these mortgage REITs. AGNC, American Capital Agency, is the common stock, and their most recent issue of preferred stock has its own ticker symbol, AGNCO. It pays a 6.5% coupon until 2024, so you get 4.5 more years, more than 4.5 years of that. Then it floats to LIBOR plus almost 5%. And if LIBOR doesn't exist, then the prospectus specifies an alternative. It's callable starting in October 2024, so that your yield is locked in for more than 4.5 years. And earnings in the underlying mortgage REIT would have to fall by 90% or more before threatening the preferred stock dividend. Now this stock is what they call cumulative. Unlike a bond where you either pay interest or you're in default, a preferred stock is like a common stock in that the board has to declare a dividend. And the board can omit a dividend. They can't omit a preferred dividend until they've already omitted common dividend. So if the common is paying 11%, that's a lot of dividend for them to have to get, that's a big margin of safety before they have to get the preferred dividend, but they can omit it. Cumulative stock means that if they omit a preferred dividend, they can't resume paying common stock dividends until they've paid back to preferred shareholders all the dividends they made. So that's a good thing. Most preferred stocks are issued by banks, and most of them are non-cumulative. If the preferred shareholder misses a dividend, that's it, not coming back. These are cumulative, so I don't think it's happened yet, but if they miss a dividend, the common stock won't get back to its 11% yield until the preferred shareholders have been paid back everything they missed. So this is a good stock. I recommend it at $26 a share or lower. I think that's in the ballpark of where it's traded. I haven't checked the last few days. Another one for more aggressive income investors, Chimera Investments Preferred B. This, I should mention that AGNC, American Capital Agency, the previous one, they invest only in Treasury-backed mortgages. So they had no problem in 2008. They had no problem with mortgage losses to default. Their issue has been interest rates. So the common stock lost a third of its value in 2013 because there was a big jump in interest rates that year. But they had no trouble in 2008. This one invests in private label mortgages. So this common stock lost 90% in the financial crisis. But again, the preferred stock is a different matter. 8% coupon for the next 4 years until 2024. Then it pays LIBOR plus 5.9%. Callable in March, at the end of March 2024. It too is cumulative. And again, earnings in Chimera Investments would have to fall by 90% for threatening the preferred dividend. So I recommend this one. This is a more aggressive thing because the business model, since they're not government, you have the added factor of credit risk in addition to interest rate risk. They don't leverage as much as AGNC does. So that they diversify the risk a little bit more. They have some credit risk, some leverage risk. AGNC is only leverage risk, and they leverage more than Chimera does to get the same yield. I recommend it below $26 a share. It's actually been trading recently above that. So now I don't recommend you put more than a few percent, let's say 5%, maximum 10% of your portfolio in preferred stocks. Because again, and I wouldn't recommend putting more than 2% in any one issue. because again, there's no risk management that's possible. If a 6% yield meets your income objective, then you buy it, hold it, and ride it up and down and collect the yield. That's the attitude you have to go in these with. So it's different from high yield bond funds where you have risk management strategy. You guys have an advantage over me. There's not a lot of liquidity in preferred stocks. So if I'm managing $200 million in clients and I want to take a 1% position in one, that's $2 million worth of shares. That's a lot to trade. These things you trade a few tens of thousands of shares a day, so maybe $500,000 or $1 million a day in total trading volume. So to move $2 million in or out is very disruptive to the market. But as an individual investor, if you want to go and with 1,000 shares or something like that you should be able to execute without disrupting the market and moving the market against yourself. So you have an advantage when it comes to preferred stocks compared to those of us who manage money funds. All right, so we've talked about this. This says diversify between stocks and bonds. Now let's turn to stocks. So covered call rights. Let me just start from review a couple of basics. A call option gives the one who owns the option the right, but not the obligation to buy 100 shares of and I'm going to be talking about this with reference to ETF. So buy 100 shares of the ETF at a pre-agreed price. That's called the strike price, on or before an expiration. And so the value of the call option rises when the underlying ETF rises. And that makes sense. So if Spider SPY is trading at 300 and I have an option to buy it at 300, the intrinsic value of that option is zero, right? Because I'm not going to make money by exercising the option. But if SPY is at 330 and I have an option to buy it at 300, then the intrinsic value of that option is going to be 30 points. So if I exercise it, I can make an immediate profit of $30 a share. But of course, the advantage of options is that if I have an option at SPY, buy it at 330, and SPY is at 330, and then SPY falls to 200, well, I lose what I paid for that option, but I don't take the loss in the share. So as a call option holder, I get the potential upside, but much less of the downside. My downside risk is not limited to the market risk. It's only limited to what I paid for the option. And because of that, because obviously all else being equal, you'd rather have upside protection with less risk, an option has to be priced above its intrinsic value. An option has to be priced so that any significant time before expiration, it has to be more. It has to be worth more than you would get by exercising it immediately. A put option gives the owner the right, but not the obligation, to sell 100 shares or to put the shares at the pre-agreed strike price on or before the expiration date. So unlike stocks, kind of like stocks, but options aren't issued by companies, so they're issued by other traders, they're created by other traders. So for every option bought, there's someone on the other side of the trade selling. And we've already seen how it's safer to own a call option than to own the underlying stock, and therefore, if you buy a call option, you have to pay the person on the other side of that trade in return for laying off the risk on that other counterparty. Now, covered call, all right, all else being equal, this is important, the longer until expiration and the more volatile the underlying ETF is expected to be, the more expensive the option. So if you're buying options, you're going to have to pay more if the markets are pricing in for high volatility. And of course, you have to pay more for an option that lasts a year rather than one that lasts a month. Covered call writing is when you buy 100 shares of an ETF, and then you sell on the options market a call option, giving your counterparty the right to call those shares or buy those shares off of you at the fixed strike price. So the red line here is the profit loss at expiration if you buy 100 shares of an ETF at 90. Believe it or not, I made this chart when SPY was trading at 90. S&P 500 was at 900 rather than 3,300. So anyway, every dollar that goes up, you make money. Every dollar that goes down, you lose money. If you sell a call option, a covered call option, let's say you get $2 right away. So you pocket the $2. So if there's no change in the stock between when you collect the $2 and expiration date, you just got $2 for doing nothing. That's the appeal. But if the stock goes up between when you sold the call and expiration, you can't get more than $90 a share. So your upside is capped at the $2 you got for selling the covered call. On the other hand, if the market goes down, well, the person who bought the option from you is not going to exercise the option. Their risk is limited to the $2 they paid you. So your downside risk, if you sold the call, is in parallel with the stock risk, except it's mitigated. So you did get that money. So if you sell a covered call and the stock happens to fall, your ETF happens to fall, at least it's some consolation. You got a little extra something to offset the risk. So the question is, again, a covered call position gives you a limited upside, gives you an unlimited downside. Why would you do that? And the answer is, you would only do that if the amount you're getting paid in this graphic, $2, is enough to compensate you for the fact that you're giving up the future upside, but bearing the risk of the future downside. Now, I'm going to just make a comment about a similar strategy. It's called cash secured put right. So if you buy an ETF for $90 a share, so you buy 100 shares at $9,000, and then you sell a covered call to someone, let's say it's for $2. That's one strategy. The equivalent in theory, the theoretically equivalent strategy is to take your $9,000, put it in your money market and your brokerage, and sell someone a put option who can put the shares to you at $90. Mathematically, that has the same risk, so it should have the same performance. In theory, sometimes one strategy works better than the other, so it's useful to know both strategies. But they're basically the same thing. If you're selling a put with the cash in the account to buy the shares that they put to you, or if you're buying the shares and then selling covered calls, either way you have the same situation where your upside is limited, your downside is not limited, but it is mitigated by the amount of money you're taking in by selling options. Again, just to review the risk measure that I like to use, the worst drawdown, this is for the Dow Jones Industrial and Tech Bubble, worst percentage decline from the peak to the subsequent valley. Like any other measure of investment performance, it's only as good as the history you use. So, the last 11 years or so has been very strong for stocks, not a typical period. So if you're testing investment strategies, I would recommend you go back 20 years, because then you have the really bad decades of the aughts and the really strong decades of the tens. And at least that gives you some perspective, although I don't think either performance is likely to be repeated in the next 10 years. I think we're going to be somewhere in between. But you have to make sure your investment history covers both advances, the periods of advance and decline. So the question is, would you have been better off just buying and holding the S&P 500, or would you have been better off doing covered calls with S&P 500 index options? And the CBOE, Chicago Board Options Exchange, maintains that data, so we can answer some questions about that. So this shows total returns for three different strategies from 88 to 2017. Again, from the Chicago option. During this period of time, the S&P 500 made 10.3% a year, had a 55% worst peak to value loss. Covered call writing, if you say theoretically, if you had bought the basket of stocks in the S&P 500 and sold S&P 500 call options, that has its own index ticker, BXM. That would have made 9.2% a year. So you would have given up about 10% of your profit. But the worst loss was 40%. Still significant, but a quarter less risky than buying and holding the S&P 500 itself. So on a risk-adjusted basis, depending, again, you have to factor in as well taxes and transaction costs, which I don't know what they would have been in your situation. But at least potentially on a risk-adjusted basis, this would have been pretty competitive. Cash secured put writing would have been even better. It matched the market, and it had a worse loss of 37% compared to 55% for the market. So this matched the market with 1/3 less risk. So this is looking pretty promising. If you're looking to tame a bit of the market volatility, the cash secured put writing using S&P 500 index options certainly looks like it has a good long-term track record. But I'll show you how you can do a little better. So implied volatility, remember I said that the more volatile the market expects the ETF, or in this case we're talking about S&P 500 index, so an ETF like SPY, the more volatile the market expects SPY to be, the more expensive options on SPY are going to be. And now the question is, are you better off selling options when the market is pricing in for bracing for above average volatility, or you're better off selling, which means that basically you're taking on risk and tapping upside at that point, or are you better off selling options when the market appears complacent? So the level of volatility that has to occur in the coming months to make today's option prices fair is called implied volatility. It's not something that's measurable. It depends on you having a model figuring out how future volatility dictates current option prices. There is an index called VIX, VIX. You can call it up on your data feed the same way you would any other index. It has its own ticker symbol. And that's an option that that's an index that measures the implied volatility of S&P 500 index options over the coming months. The long-term average is about 19.5%. So that's annualized standard deviation of the S&P 500. The higher the level of implied volatility, the higher VIX, the more money you get for writing options on SPY. And of course, what really counts is not whether VIX is high or low, it's whether the coming month is more or less volatile than the option market expected it to be. So if the option market expected volatility to be high, and it turned out that volatility actually came in higher than they expected, you would have been better off buying options. But if the market volatility is projected to be low, and then the coming month is even quieter than expected, you would have been better off selling them. So what really counts is there a tendency for VIX to overshoot or undershoot what actually comes down the pipe? The answer has been very convincing, is that the time to do covered call writing, at least with SPY options or S&P 500 index options, is when people are scared, when the option market is scared of volatility. So this is the annualized return when VIX is 19. So that's 19 or higher. So that's above average to above average volatility. S&P 500 itself rose at an annualized rate of 11.3% a year. So the market is above average profitable when option volatility is higher than average. Covered call writing beat the market 13.2% a year, and cash secured put writing did even better, 14.7% a year. When the market is complacent and VIX is low, S&P 500 only rose about 8.6% a year. So below average return just buying and holding when you're starting from a period of complacency. Covered call writing lagged significantly, making only 5.5% a year. And cash secured put writing, 6.5% a year, still lagged. So very different behavior. And part of the reason why this is that option prices, volatility expectations tend to increase when the market falls. So if you're going to open a covered call position when option implied volatility or VIX is above average, that almost always happens after some kind of market decline. So when you're holding only during high volatility conditions, what that means is you're basically buying a dip, and that's a strategy that on the long term has worked out well. And that's why the market does better when volatility is high, and also why option selling does better when high, is because those conditions occur after the market's already pulled back. The complacent condition, the market's most complacent at the top. So even though you can have a year like 2017 when options were cheap all year and it was a great year to invest, that happened then too. But then again, in middle of 2018, option volatility prices have come down too. So time to be more confident in investing is actually when everyone else is running scared. Now I have to, all right, so this suggests a strategy. This dichotomy here is just a strategy. What if you buy and hold when VIX is low? When options are cheap, don't bother selling them, just buy the market. And conversely, when options are expensive, that's when that's when these strategies have historically been more profitable. So you only do the option selling when options are average or above average expensive, and otherwise you just invest in the market when options are cheap. So during this period of time, S&P 500 made 9.8% a year. Covered call writing, as we saw before, lagged by about 1%. Cash secured put writing matched the market. Switching between covered call writing, so you're writing covered calls when options are above average expensive or average expensive, beat the market and beat covered call writing. So switching between the two strategies beat either one separately. And cash secured put writing, again, outperform either put writing all the time or buying and holding all the time. So save your covered call strategies for when option prices are expensive. Now, I have to emphasize, I always cringe when I hear people say that they're brokerage holders, that option covered call writing is a conservative strategy. Okay. You are exposed with some mitigation to the market risk. So the S&P 500 had a worse drawdown, 55%, covered call writing 40%, cash secured put writing 37%, right? Switching between covered call writing and the S&P 500 according to VIX, 44% worse loss, cash secured put writing, and switching between the S&P 500 and cash secured put writing, 40% worse loss. So the point is that any strategy that can lose 40% isn't conservative. So just keep that in mind. I mean, the covered call writing is an equity strategy. It's not, it produces income every month when you sell the option, but it, in your risk budget, it counts in the equity side, not the bonds. And the real danger with covered call writing is what if the market crashes? So here's what happened in 1987. The green line here is the S&P 500. It reached a higher peak than covered call writing with cash secured put writing, the red blue line, and then it fell lower, right? But the one-day drop of more than 20%, the 2% or what you might have gotten for writing a covered call is of some but very little consolation when the market's dropped 20%. So if there's a one-day market crash and you have a covered call position, you're exposed to basically the full brunt of that crash. So this won't protect you against that. It's a good protection against a very prolonged bear market. So for the tech bubble burst from 2000 to 2003, during that period of time, the worst loss in the S&P 500 was over 50%. Covered call writing would have lost about 33%. Still risky, but fully a third safer than the market was during that period because it was a prolonged bear market. One-day crashes just won't give you much reduction in risk. But the nice thing here is that the S&P 500, after it hit bottom October 27, basically went sideways the rest of the year. We tested it low, but basically didn't really start recovering in earnest until next year. Whereas covered call writing and cash secured put writing, you can see after the crash recovered very briskly. In fact, they recovered by the end of the year almost half the losses on the day of the crash, whereas the S&P 500 had hardly recovered anything. And the reason is, of course, is that after the market falls 20% in one day, people are very anxious to own options and instead of owning stocks. So the prices for these options got really, got bid up to a high level. Everyone found religion. And so if you had the guts to sell options after the crash had occurred, and that would require a lot of courage, but if you had that courage, you were extremely well rewarded for it. And as a result, you were able to recover, according to this, about 20% in the space of 2 months. Now, there are other covered call indexes available from the CBOE. They have data that cover options on the Dow Jones Industrial Average, the Russell 2000 Index, and the NASDAQ 100 Index. And I'm just going to say that these other options haven't worked as well as the S&P 500. So for whatever reason, S&P 500 options have been better priced for option sellers than these other index options have. So if you're going to use this with ETFs, the U.S. equity ETFs, just stick with SPY. Don't look in these other indexes for covered call writing strategies. It hasn't paid off. I sometimes do covered call writing on EEM, that's the market index ETF. That's something to think about, but sometimes simple is best. Stick with SPY when you cover call. Volatility. This is just a little historical perspective outlook for the strategy. Volatility ebbs and flows. So in 2015, we had really a two market correction, 2015, 2016. Volatility spiked. VIX, it said the average was 20, it was 19, it was spiked as high as 40. Started the year in 2016 spiking 25 to 30. Great time to start covered call writing. All right, so 2015, 2016, high volatility. 2017 was the quietest year on record for market volatility and for option prices. So there was no temptation to write covered calls in 2017. 2018 started with a spike in volatility and ended with a spike in volatility. So 2018 was a pretty high volatility year. And 2019, even though it was a great year for stocks, you can just look at the price trend in 2017. It pretty much just went up in a smooth way. Compared to 2019, where it went up even more, but you had more significant corrections, so higher option volatility. So there were some good opportunities for covered call writing in 2019. And as we started 2020, there have been some recent bumps in VIX. I think VIX touched above 19 at one point in January. So it's something to keep an eye on, the VIX index, and we do seem to be in a situation where there might be some opportunities coming up. I don't see another 2017. Now, one of the factors that has a big impact on volatility is the Fed. And so this is the blue line is the Fed balance sheet. What that means, basically what the Fed does is they print or virtually print money, and then they go out and buy things. So the balance sheet is how much money, the running total of how much net they've printed, and then gone out and bought Treasury securities or mortgage-backed securities. Now, before 2008, there wasn't much going on. But then starting in 2008, in order to mitigate the damage from the financial crisis, they turned on the printing presses and started quantitative easing. And you can see, so this is the rise in the size of the balance sheet. But what's interesting, and the orange line here is option implied volatility. So big spike in VIX up to a level of over 70 during the financial crisis, which makes sense. When the Fed, after the financial crisis, after the initial wave of default in 2008, when the Fed would crank up the printing press, when it was stimulated, volatility dropped. So the rectangles are when the Fed has changed course from stimulus to neutral. So here in the first round in 2010, the first round of quantitative easing expired, volatility spiked. So they crank up the presses again until 2011 when again they turn off the presses, they stop the quantitative easing, and volatility spiked again. Now they announced in 2011 they were going to have open-ended quantitative easing, not a time-limited version. So they're steadily ramping up the size of their balance sheet by printing $75 billion a month and buying bonds on the open market. Volatility stays suppressed. When they turn off the printing presses again, in 2015, volatility spikes. Now 2016, let's say this is the middle of 2016 to 2017, to the end of 2017, the Fed was basically in neutral mode and the option market calmed down on its own. When they started contracting its balance sheet in 2018, in other words, some of these bonds they printed money to buy, they would just let them mature, and instead of reinvesting the principal, would just make the money disappear, the reverse process of how they created it in the first place. So they're contracting the balance sheet in 2018, volatility is rising. Now, there have been dislocations in the money markets. Not sure what that means. As best I can tell, it's the banks that have the cash don't want to lend it to the banks that need the cash. So there were a certain number of banks caught flat-footed, unable to borrow an overnight market. And so the Fed stepped in, created a lot of money, and bumped up its balance sheet. And again, volatility is gone down. So the Fed is a big issue in this. So if the Fed is in tightening mode, that's when you're going to get the opportunity in covered call writing. The Fed is going to be pedal to the metal, stimulating the economy. That's when you're more likely not to find good opportunities in covered call writing. Okay, so now options. What do you do when options are cheap, like in 2017? We've started doing the reverse strategy for covered call writing for our clients. Instead of selling options when they're cheap, we buy an option. Because remember, we said that if options are cheap, you get the potential upside, and you get protected from the brunt of the downside, but you have to pay up. So we buy, for example, an in-the-money index option on the S&P 500, 5 to 10% in the money a year to expiration. Let's say you have to pay about 5 or 6% for that. So if the market's absolutely flat and I buy this S&P 500 index option, I'm going to lose 6%. So I'm going to trail the S&P 500 by several percent. I'm not going to get the dividend, and I'm going to have to pay for the option. On the other hand, if the market crashes, my loss is limited to what I paid for the option, which is about 13% of the capital that's represented. And if the market goes up, like in 2019 to 2017, I still get a good return. But I can do better than that, because instead of laying out, let's say instead of laying out $330,000, I buy this option, $330,000 to buy 1,000 shares of SPY. Let's say instead I buy one of the 10 SPY call options. And let's say that, roughly speaking, they might cost me, instead of laying out $330,000, I might have to lay out, let's say, about $40,000. So I can get the same upside market exposure that I could for $330,000 worth of an index fund, just buying options, 10% in the money. Let's say so the strike price is 10% below the market is, expires in a year. I can lay out $40,000 and get the same upside market exposure as I would by buying $330,000 of index fund. I still have $290,000 to work with. So then I can put that money to trade high yield bonds. So now what I've done with this, and the potential return from trading high yield bonds is close to enough to pay for the cost of the option. So what I've basically done with this strategy is I've converted the stock market risk into a high yield bond fund trading risk, which is considerably less. So this is something that we started doing for our more aggressive clients. It's aggressive in the sense that you're basically doing two strategies for the same money. So, but it's conservative or more conservative in the sense that if the market goes to zero, my likely risk is far less than if I had just been buying and holding any of the underlying investments for the high yield bond or an S&P 500 index. So to summarize, all right, strategies for volatile low yield markets. The mainstay of our bond strategy for clients, and the one I recommend most strongly for you, corporate high yield bond fund trading. Excellent risk-adjusted return history compared to stocks or bonds, especially in a lower yield environment. Floating rate bond fund trading. Better for when the Fed is raising rates, probably not quite as attractive now. They were very attractive in 2018. Floating rate preferred stocks for buying and holding. Again, you get about 6% yield. You have to ride them up and down, but there are not too many places you can get a 6% yield these days. And then covered call writing, cash secured put writing when option prices are high, or long call options to replace equity positions, and high yield bond fund trading when options are cheap. And of course, what we do in my newsletter and for our clients is market timing. So that's important in risk management as well. Here, this book, Higher Returns from Safe Investments, that came out in 2010 by Paul. That covers the high yield bond strategy and also talks about trading high yield municipal bond funds if you're tax sensitive. It's a nice strategy, a good diversifier for high yield corporate bonds because the high yield muni bonds often behave more like treasuries, more like investment grade bonds than they do like corporate junk bonds. So if you want a copy of this slides from me as a PDF, mappel@signalart.com. If you have any questions about money management or about my newsletter, system forecast, where we, by the way, do post equity and high yield bond fund timing signals, as well as market commentary geared towards people who do technical analysis, who read charts, but also some personal finance in there and general market outlook is in there. You're welcome to sign up for, just email me or sign up for a website for a free trial if you like. So I think now that that concludes the first half of my talk. And so if there are any questions, I'll take them. Otherwise, thank you for your attention. And then I think I have a drawing to wrap on. So thank you all very much.
Okay, we're ready for the second half of our program. And, the title of this, the title that went into Chicago was Tactical Strategies for Emerging Markets. We're going to talk a little bit about that area of investing, which, as mentioned in the write-up, is something that sometimes goes and sometimes doesn't. That's the way the markets are. Can you hear me? Okay. We'll be covering such areas of how to recognize opportune times to invest in emerging markets and when the U.S. Equities are potentially better, why emerging markets appear to offer a long-term attractive opportunity for equity investors, and 2020 equity market outlook. I'm looking forward to that. So Marvin, your mic's on, you're live.
All right, good. Thank you very much. Yeah, I'm gonna close with some equity market outlook, but the main thing I'm really going to talk about here is I'm going to read my PowerPoint. What I'm really going to do is show you a technique to compare the relative performance, and you can apply it to any two different markets you want to switch between to try to identify which one is potentially stronger. So I'm going to start with describing the relative strength. For those of you who do technical analysis with something called a relative strength index, RSI. That's not it. This is not it. This is just a technique that you can use yourself to compare relative strength between two different areas of the market to guide your decisions whether you want to overweight one or the other. When I proposed the title for this talk, I thought I would talk only about emerging markets, but have the time also to give you a model for developed non-U.S. versus U.S. markets as well. So I'll give you two specific models you can use, and I'll give you the technique for those of you who do your own research. I know that the computerized investing group, this would be right up your alley. I'll give you the technique that you can use for yourself to create your own models if you want to. And then I'll close with the implications of the presidential election on the stock market or vice versa, and the valuation. So the concept of relative strength is a very simple one. It's basically a way of either numerically or visually identifying which of two different areas of the market is stronger. And it's basically, so you have your index 1 and index 2, each representing two different areas of the market. Again, let's say it's foreign stocks versus U.S. stocks. So index 1 might be a foreign equity index. Index 2 might be the S&P 500. And all you have to do is divide index 1 divided by index 2. You're getting a ratio. And it could be price-only indexes, or it could be total return. So when you're dividing index 1 divided by index 2, foreign, again, in this example, foreign stocks divided by U.S. stocks, if that ratio is rising on the chart, it means the index 1 is stronger. So if you're looking, as I'll show you the specific models I'm going to share with you, foreign stocks divided by U.S. stocks, if that ratio is rising, it means foreign stocks are stronger. If the ratio is falling, it means U.S. stocks are stronger. That doesn't mean that you're making money. Okay, index 1 can be stronger than index 2 with the ratio rising if it's falling more slowly or rising more rapidly. Okay, and so this chart here, the blue line is index 1, the gray line is index 2. So if I have a ratio of index 1 to index 2, that's the bottom part. So you can see for the first start of this chart, index 2 is rising faster than index 1. So the ratio index 1 divided by index 2 is falling. Now, if you had perfect foresight, the time to switch from index 2 to index 1 is, in other words, when index 1 starts to do better than index 2, is at the nadir here in this ratio. So you switch at an extreme in the ratio with perfect foresight. Here, they're both falling, but index 1 is falling more slowly, so index 1 is stronger, so the ratio is rising. Here, index 1 is rising, index 2 is flat, so the ratio is rising. And here, they're both rising, but index 1 is rising more quickly, so the ratio is rising. So obviously, you can't do this in real life, but the goal is to try to pick turning points in the ratio of index 1 and index 2 to guide your switching between the two of them. So let's say we did that. Let's say you had a perfect timing model. You start off in index 2. The dashed line here is your equity price, your trading. So again, just assuming you had perfect foresight, you would start off in index 2, which is stronger, so your returns would track index 2. Then at the peak relative performance of index 2, you switch. So now you're falling with index 1 more slowly than index 2. So your equity curve is now holding up better than index 2. It's tracking index 1. And at the end of this period, because you switched at a perfect time, your results have actually beaten either index separately. And that's the goal. If you're switching between two markets, your goal is to somehow outperform either market separately or to outperform a naive portfolio of half invested in each index. So how do you recognize it? Well, this goes back to the same idea, the same general principle that I talked about with trading high-yield corporate bond mutual funds, is you don't reasonably expect to call the turning points in advance, but if there is a longer-term trend, if your two indexes you're looking at have a tendency to outperform or underperform for extended periods of time, your goal is to recognize a turn in relative strength and outperformance shortly enough after it's occurred to be able to take advantage of the rest of the trend if there's going to be one. So this is, again, an index 1 divided by index 2. This is not an index. This is just a ratio. The perfect turning point to switch would be here, but you're not going to recognize the turning point there. You're going to recognize it after. And hopefully there'll be enough of a trend to continue. Let's say it goes down to there. So here index 1 is stronger. Index 2 starts being stronger here, but you don't recognize it here until here. So here's where you might do your switch. And You wait until you come down to a new extreme, which you don't predict. It bounces, right? But now index one has taken over leadership. And sometime after that, you maybe recognize a new trend here and hope that there's enough left to profit. That's the theory. Another way you can do, again, it's still motivated by the same idea, right? That you don't know when the turning point is going to occur. The goal is to predict, is to recognize a potential turning point soon enough after it's occurred so that there's still room to profit. You can do a moving average of the ratio. So instead of waiting for a fixed pullback as we did with the high yield bonds, a 3% reverse change in direction, that was the signal. Here you just say, okay, you do a moving average of the ratio. This is a 3-period moving average. So when the ratio crosses from above to below its moving average, that's a switch. So when the ratio is above its moving average, you're in index 1. This is index 1 divided by index 2. So index 1, the numerator, is stronger when this is rising. When it's above the moving average, you're in index 1. When it's below the moving average, you're in index 2. So what you want to see, of course, is that index 2 is stronger when the ratio is falling. So you want to see most of the fall occur while it's below the moving average, and most of the rise occur when it's above the moving average. So in this, again, this is all fictional data, but in this example, you had a nice trend down here. You got out of it here. Big trend up here. All right, you got out of it here. Now this, unfortunately, this is what happens in real life sometimes. You peak above the moving average and you think, oh great, new trend. But no, it turned out to be a fake out, and the market turns around. So this is how this kind of strategy can cost you money. Nothing has 100% success. So the trade that costs you money is when you cross direction in the moving average, but then don't continue in the same direction. So in this instance, you thought you had a new trend, but you didn't, so you get back here. And so when you bought here and sold here, you actually lost the money. Again, this is the drawdown measure. Worst peak to valley loss. That's what we measure. Academic studies a lot of times talk about standard deviation. I've never had a client complain to me that the standard deviation of their portfolio is too high. This is the real pain, the percentage loss. So, all right, so now let me show you two foreign equity relative strength models. The first one is IFA and the S&P 500. Now these days, IFA is mostly mostly Western Europe. Japan is the other big constituent, but in the 70s and 80s, when the Japanese markets were booming, Japan was a very significant component in IFA. And what I have circled here, this is data from MSCI, and I have circled 4 periods of time over the last 50 years when there have been big differences in performance between U.S. and foreign developed country stocks, as represented by IFA. IFA stands for Europe, Australasia, and Far East. So here, for example, in the later 70s, the S&P 500, the orange line, went nowhere. But you had a big boom in non-U.S. equities. Now, in the late 80s, good time for U.S. stocks, but a much better time, probably propelled by Japanese stocks, a much better time for foreign stocks. So this is a period of time when the dollar had peaked and started coming down. So you can see we had the crash of 87 here, much less impact on non-U.S. stocks. Now then we had a period here from 1990 to about 2000. Notice that we started after a big period of outperformance by foreign stocks, foreign developed stocks, way ahead of the S&P 500. By the time this decade ended, they were behind the S&P 500. So in the 90s, the U.S. markets far outperformed foreign markets. And now, in the last 10 years, another period of time, again, they started at the same. So if you had invested in 1970 in IFA versus the S&P 500, 40 years later, you would have ended up in the same place. But in the last 10 years, IFA, the blue line, foreign developed country stocks, have far lagged the S&P 500. So there's a lot of potential here for adding to your investment performance if you can time the switches right, because there are periods of time lasting several years when one or the other has performed much more strongly. So here's the model. Use the IFA index as the benchmark for developed country foreign stocks and the S&P 500 as the benchmark for U.S. Calculate each month the total return ratio of IFA and the S&P 500. This is the last trading day of the month. A new trend is defined by crossing what's called a 19-month exponential moving average. You do stock charting. The software will have that for you. If you have an Excel spreadsheet, I'm going to give you on the next slide what the formula is for your spreadsheet. And you don't have to worry about the index data. You can use ETFs. EFA is an iShare that tracks EFA, and SPY, of course, tracks the S&P 500. So the exponential moving average, you will need last month's exponential moving average, this month's of the ratio. So again, each month you calculate EFA divided by SPY. That's the new ratio. That's the new data for this month. You have last month's exponential moving average. Obviously, you have to start somewhere. So, the first month you start, you don't know last month's average. So you can just start with this last month's ratio as the average and give it a year's worth of data so that the impact of using the different starting data is diminished. So the new exponential moving average is 0.9 times last month's average plus 0.1 times this month's new ratio. That will give you the new average. And then the model is if this month's ratio is above this month's new average, you're in EFA. In other words, because you're dividing EFA divided by SPY, so foreign divided by U.S. stocks, that ratio, if that ratio this month is above its new average this month, then you're in foreign stocks. If for the coming if on the other hand, after you do this calculation, you find that this month's ratio, EFA divided by SPY, is below the moving average of that ratio, then you're in U.S. stocks for the coming year. So this chart, again, this shows that same 50-year history of EFA. EFA is the blue line, SPY, S&P 500 is the orange line. This is the same 50-year history, and these are the relative trends in performance. So you can see in the late 80s, rising, remember, means EFA is stronger. Strong outperformance by foreign stocks. Early 90s, strong outperformance by U.S. stocks. You had a blip in foreign stocks in the mid-90s and another period, several years of strong outperformance by U.S. stocks. You had a moderate outperformance in foreign stocks through most of the aughts. And then in the last 10 years, a very consistent trend favoring U.S. stocks over foreign stocks. So you can see there's some big trends to trade. The orange line is the moving average. And again, what you want to see is that most of the time that the blue line is rising, it's above the moving average. And most of the time it's falling, it's below the moving average. That means that the model would have kept you in the right place at the right time. This shows you where the model actually did keep you. So the blue line is when the model was in U.S. stocks. So you want it to be blue when that ratio is falling. You want it to be orange when the ratio is rising, because that's when you would have been in foreign stocks. And you can see that most of the time when there was a major trend, you were in the right place. Not always. For example, here in the later 90s, there was a blip to EFA that wasn't really in line with the prevailing trend. In the last 10 years, during most of this time when U.S. stocks have been outperforming, you would have been in U.S., this model would have kept you in U.S. stocks for all but 8 months of the last 10 years. So these little patches of orange, these would have represented unproductive or maybe counterproductive trades, but overall you were on the right side of the trend. Yes? All right, so this again is the orange line is S&P 500, blue line is EFA. This is the gray line is what you would have gotten, and not counting taxes or transaction costs, what you would have gotten switching. All right. So EFA during this period of time made 9.4% a year with a 56% worse loss based on monthly data. S&P 500 made 10.8% a year with a 51% worse loss based on monthly data. You may recall in the last hour I talked about the S&P 500 had a 55% worse loss. That's based on the daily data. So if you go from the highest daily close to the lowest daily close, that was 55%. If you're only looking at the data every month, the highest monthly close to the lowest monthly close, 51%. Switching outperformed either one, made 11.9% a year, would have made, hypothetically, with a 54% worse loss. So switching between the two doesn't really improve the risk, but it has improved the return. Now, a lot of people say that you should diversify to include international stocks, and I would argue that this data shows otherwise, that if you're a very, very long-term holder, there was no advantage. And there were some periods of time, including the last 10 years, when there was a severe disadvantage. So what you are getting for non-U.S. stocks is added currency. So my recommendation is you should invest in foreign stocks only if you have a specific reason to do so. Maybe the reason to do so is you have a mutual fund that beats its benchmark by a significant margin. That's a good reason. Or maybe the reason to do so is you have a model like this that tells you when the trend favors international stocks. So I would not diversify. I would not recommend diversifying internationally just for the sake of it. It hasn't mitigated losses during the major market declines, and it hasn't improved your returns compared to just being in the S&P 500. All right, so that was our that was our developed non-U.S. stocks versus S&P 500 model. EFA again is foreign developed country stocks. Right now, of course, the model does favor U.S. stocks, so this will give you a clue as to when the trend might change in favor of foreign stocks. Certainly, they've been beaten down for so long that it wouldn't be surprising to see a change in favor of them. But I can't say when that's going to be. And I just point out that this again is the ratio foreign to U.S. stocks. Foreign stocks are lagging. This is a historical low, right, going back 50 years. Foreign stocks are weaker now relative to the U.S. than they've ever been. So eventually they're going to switch, but I can't say when, and this model might tell you. Emerging markets. This is an old chart. I'll update it for you with more data, but from 88, when the MSCI Emerging Markets Index was first launched, until 2016, they both actually returned about the same. The S&P 500 slightly outperformed emerging markets. But again, look at the difference. So from 88, difference in different years. So from 88 to 94, that was a great time to be in U.S. stocks, but it was an outstanding time to be in emerging market stocks. However, from 94 to 98, a really strong time to be in U.S. stocks, a terrible time to be in emerging market stocks. They had a 50% bear market. From 2002 to 2008, again, strong time to be in U.S. stocks, but a much better time to have been in emerging market stocks. And then since the peak in 2008 or 2010, emerging market stocks have returned practically nothing in the last 10 years, whereas, of course, the S&P 500 has done very nicely. So, again, as a long-term holder in emerging market stocks, you really haven't been better off. You've been a bit worse off. So keep that in mind. Now, this chart, the blue line here is the ratio, emerging markets divided by U.S., and the red line is the moving average that goes with it. And again, the model is when the ratio is above its moving average, you're in emerging market stocks. When it's below the moving average, you're in the S&P 500. And what you want to see is that the blue line is falling, U.S. stocks are stronger, when it's below the moving average, because that's when the model would have you in U.S. stocks. And when the blue line is above the moving average, that's when it has you above, that's when it has you in emerging markets. That's when you want to see it rise. Yeah, so I was going to get into that. I'm using a slightly different moving average here, and here I'm guilty of something that's an occupational hazard, is a little bit of optimization. For whatever reason on this data, this type of moving average, which is a slightly different one, works better. So you never know. On the one hand, you don't want to make too many tweaks. On the other hand, you don't want to ignore something that works a little better. So these systems are not heavily optimized, but they're a little optimized. And meaning I didn't try 10 million different simulations. I'm sharing the one that worked. But I did try more than one simulation, and I'm sharing the one that these data worked best. The one thing I will say, though, is that I developed these models years ago, and I haven't needed to update the parameters. They're still continuing to work. So the summary of the EFA versus S&P, I'm sorry. I guess my slides are a little bit out of order. Okay, so this is the monthly switching model, emerging markets versus U.S. On the last trading day each month, update your total return index for the MSCI emerging markets and for the U.S. And then calculate the ratio of those two indexes. And then you can use ETF. So instead of worrying about getting MSCI data, just use EEM or SPY, or if you like the Vanguard ETF, which has a similar behavior as EEM but has a lower expense ratio. You can use those. So EEM divided by SPY, last trading day of each month. Calculate that ratio and calculate the average of the last 10 months of that ratio. So that's your simple moving average. If the ratio is above, if the newest ratio is above the newest moving average, that is to say the last 10 months, including the current reading, then you're in emerging markets for the following month. If the ratio is below its average, then you're in S&P 500 for the coming month. And the model has been in the U.S. since February 28th of last year, for 11 months. Calculation of the 10-month moving average. Again, it's just the average of this month's ratio and then the previous 9 months. So you have the most recent 10 months available data. Simple average of that. That's your moving average. 10-month simple moving average. So, for example, at the end of this month, you're gonna find EEM divided by SPY, and then you're gonna go with the 10 months before that. So May, June, end of May, end of June, end of July, end of August, up to the end of September. That will be most recent 10 months of data, EEM over SPY, take the average of that, compare it to the most recent, just the end of February, and that will tell you what to do. All right, so here's the result of switching. During this 28-year period, emerging markets made 9.8% a year with a 61% worse loss, so that's riskier than the U.S. market. U.S. market made 10.2% a year with a 51% worse loss. Switching using this strategy, hypothetically, would have made 16% a year with a 53% worse loss. So you can see you far outperformed either index. And that makes sense because there was a lot of opportunity to get on the right side of a major trend that strongly favored one or the other. This is an update. Again, switching outperformed either index separately, or the purple line here is a naive portfolio happening. So switching continues to outperform either index separately. Here are the last few trades of this model. So from July 2016, end of July 2016 to April 30th of 2018, this model was actually in emerging markets, during which time EM gained 34% and SPY gained 26%. That was a successful trade. Then we switched to Spider for emerging markets from April 30th, 2018 to January 31st, 2019. During that period of time, SPY gained 3.6%. You wouldn't have been in emerging markets, and that's a good thing because they lost 6.2%. So that was a successful trade. Then we have one of those one-month flipsaws, bad trade, in February 2019, so you would have been in EEM, losing 1.5% rather than making 3.2% in Spider, so that was a bad one. And then since then, you've been back into SPY, and since then, emerging markets have, in the last 11 months, emerging markets have been up 5.3%, SPY is up 19.5%. So this model, even though I developed it several years ago, continues to work. We almost had an emerging markets buy at the start of this year. This is a chart of emerging markets, and it's 200-day moving average, which is, since there are 21 trading days in a month, the 200-day moving average is very close to a 10-month moving average. We came very close to getting a trade. If January had finished strongly for emerging markets, we would have been in emerging markets for the first time since 11 months. So we were in a percent or two of relative performance gap of getting there. But then the coronavirus thing hit, and emerging EEM right now, emerging markets index, is about a third in China, and then another 10% each in Taiwan and Korea. So it's very China dependent. And so with the coronavirus, of course, emerging markets are taking a big hit. They're now at a new relative strength low, and so we dodged that bullet. So still favoring U.S. equities as of January 31st. Why I like this model is that emerging market valuations are attractive. So this is price to earnings. So lower means cheaper, and U.S. stocks, you can see, are much more expensive than either developed non-U.S. stocks or emerging markets. So I'm not saying valuation is a very crude tool to time your investment decisions. So I'm not saying that because of valuations are this way that you should switch, but I am saying that because valuations are this way, when the market momentum starts to switch, if it does, you will have a valuation tailwind, and that's a good thing. So For this reason, I think it's worth keeping an eye on opportunities to invest in foreign stocks, but I wouldn't recommend doing it until the market tells you that it's potentially attractive. Another good thing for emerging markets is the U.S. dollar. Foreign stocks in general, but emerging markets particularly do better when the dollar is falling. That's a tailwind. When the dollar is rising, that's a headwind. Pulls them back. This is an ETF that tracks a basket of currencies against the U.S. dollar. So when it's rising, it means a stronger dollar. This ETF in its 13 years of existence has never gotten above 27. And you can see it recently bumped against the high end of its range and pulled back. But looking at the range over the last 13 years, the dollar is still very much at the high end of the range. Looks like it has more room to get weaker rather than stronger. So this is, again, this is not a reason to switch into foreign stocks now, but it's one more reason to think that there could be an opportunity developing in those stocks when the market switches. Okay, now market outlook. Let us pray. All right, election years are good for the stock market on average. So this is data from Ned Davis Research, averaging the Dow Jones Industrial Average from 1900 to 2016, I think, and it basically shows that most years on average have been up for stocks, but the best year historically has been the pre-election year, and 2019 was certainly no exception to that. Election years have been on average profitable for stocks, but you can see, again, this is on average, it's not any particular year. The first half of election years have tended to be troublesome for stocks, and the real gains have come on average at the end of election. The worst year was the midterm year, again, 2018, no exception to that, and the post-election year also somewhat profitable, 2017 and 2013, 2009, being good examples. But if you look a little bit further into the history, what it turns out to matter whether the incumbent party is destined to hold the White House or not. So the red line is the average performance during all election years. It's weaker in the first half, stronger in the second half. But if the incumbent party doesn't mean necessarily the incumbent president, the same party is destined to hold the White House, stocks have finished very strongly. If the same party, if the White House is going to turn over to different party, to the other party, a weak finish to the year. And in particular, these 3 months that I've boxed here, right, that cover September, August, September, October, that's where the real differentiator is. So if the election is likely to turn over the White House, before that happens, the market is strong. If the election is going to keep the same party in the White House for 4 more years, before that happens, the election is, the market is strong. So it's not so much what will the election mean for the market, it's what the market means for the election. This is a table of the performance of the S&P 500 price-only return, July 31st through October 31st. So August, September, October, 3 months. It's been a very reliable indicator of presidential election replacement or retention. This table came out of S&P, I got it out of Bloomberg, and it was in 2012, and it worked in 2016. In fact, the market lost a little bit. The S&P 500 lost a couple of percent in that 3-month period, and I have to say that therefore I was not complacent about Trump winning. So being the diligent type that I am, I said, well, I think Trump is going to win. I don't care what everyone's saying. So I positioned my clients more defensively. So Trump did, in fact, win, contrary to most everyone's expectations. And then contrary to everyone's expectations, he won and the market took off. So that didn't turn out to be such a good move. But just goes to show. This indicator has about 5 and 6% success rate, 5 out of 6. So that's pretty good. I mean, both ways, whether it correctly predicts re-election or replacement. So if you want to know how the election is going to go, on October 31st, see what the S&P 500 did between July 31st and October 31st, and that will be a reasonable indicator. So, January started off badly. That's not historically atypical. February is going strong, but we have to see. So I'm not expecting a gangbuster year. We'll have to see what happens. But as far as the election is concerned, this is really the thing. And I suspect it's because the same underlying conditions that cause people to be pessimistic about stocks cause them to be pessimistic about the incumbent party. Um, Stocks right now are priced for perfection. So this is from Robert Schiller's data on his website. Goes back to 1900. What is the earnings yield of the S&P 500? In other words, how much annual earnings do you get for every dollar you invest? So that's ranged from a high of 18%, around World War I, and a low of like 1% at the close of the market crisis. So if you invested $100,000 in the S&P 500 index fund at the worst performing part of the financial crisis, you would have been buying only $1,000 of earnings, 1% of earnings. Right now, you buy about 5% a year in earnings. So for every 100,000 you invest in the S&P 500, your basket of stocks is earning about $5,000 a year. And you can see that is very much at the low end of the historical range. Again, valuation is a crude tool. That doesn't mean to sell short, but it does mean that you'd be hard-pressed to argue that stocks can get more expensive just based on people paying more for the same dollar of earnings. So if you look here in late 1970s, the earnings yield was close to 15%. So if stocks were trading now at the same valuation they were 40 years ago, the S&P 500 would be trading at 1,100, not at 3,300. Two-thirds of the market's gains in the last 40 years have not come from earnings growth, but from investors paying 3 times more for the same dollars of earnings as they were willing to do 30 years ago. That doesn't mean that we have to revert to this, and it doesn't mean it can't get more expensive, but at some point it has to stop. So I think it's reasonable to project going forward in the long term that stock price growth is going to be more closely tied to the actual rate of earnings growth and not so much tied to people willing to pay more for the same dollar of earnings. In other words, we're going to see slower market gains going ahead. Business has it pretty good right now. This is a chart from the St. Louis Fed. This is after-tax profit, corporate profit. And right now, about 9% of GDP is after-tax corporate profit. Reached a high of over 11% under Obama, but compared to the 50s, 60s, 80s, 90s, which were considered good periods of time for American business, corporations are taking a larger share of the economy now than they did even during the 80s and 90s. And this little blip here is the Trump tax cut. So while that had a nice impact on the market, in the scheme of things, it doesn't really change the fact that corporations still have it quite good. Again, that doesn't mean that Bernie Sanders is going to be elected and we're going to be back down here. That may or may not happen. But it does suggest that the period of time in the last 20 years, corporate profits have grown faster than the economy. And that's after tax. I wouldn't bet on that trend continuing for the next 20 years. I like to bet on things to stay the same. So again, this is another tailwind. First is valuation. Second is corporate profit growth outstripping economic growth in this country. These are two things that I don't think can continue forever. I think it's more reasonable to think that things are stabilized where they are. Again, one more argument why I think future stock price gains are going to be more in line with actual profit gains, which, by the way, have averaged about 6% a year, rather than the double-digit returns that have been the 90-year average return for the stock, much of which is based on paying more for the same dollar of earnings. Now, the good news for stocks, so why aren't we trading at 1979 valuations? And the answer is because interest rates are a lot lower. So, how much is the dollar of earnings worth? It depends on how fast they're growing, and it depends on what the alternative is for safer money. So if you compare stock earnings growth with actual bond yields, in fact, stocks are undervalued, because earnings are growing, and interest rates are so low that even with the current relatively modest growth rate that's expected for companies this year, because interest rates are so low, stocks are actually a little bit undervalued according to the naive model of discounting future earnings. So that's the good news. Interest rates are a big support to why stock prices are as high as they are now. Again, how much lower can interest rates go? We can go as low as they are in Germany. I hope we don't. That would make my job as an investment advisor harder. It's a lot harder to generate positive returns when interest rates are negative. But even if they stay where they are, it rationalizes current stock price. But again, interest rates are really low, and I don't see them trending a lot lower over the long term. One more reason why I don't see a major bear market based on where interest rates are. When the interest rates got a lot higher at the end of 2018, it could trigger a market sell. So that could happen again easily. But I think that if we get another tailwind of declining interest rates, that is not going to be there going forward. Okay, so now my 400th slide, PowerPoint poisoning. That's all I have to say. I thank you all very much for coming out on a Saturday morning. This is a book that I co-wrote with my father on includes an asset allocation strategy for foreign equity ETF. These are my other two books, and this is the book that covers higher returns for safe investment. Covers a bit on covered call writing and on my high yield bond fund trading strategy, and also talks about how to trade high yield municipal bond funds, which are tax sensitive. And again, if you'd like any information about what I do or my newsletter or copies of these slides sooner than they're going to be posted on the website, please feel free to email me. And if you have any questions about your own personal financial planning issues or anything like that, I'd be happy to take a stab at that as well. So thanks again for the invitation to be here. It's a real pleasure.
Any questions? One interesting thing that you showed was a lot of people argue about whether you should have any stocks overseas as opposed to stay directly in this market. I think you showed us an example of the benefit in both areas and what to be done with it.
Well, I just reiterate that you should be in U.S. stocks unless you have a specific reason to be abroad. Again, that reason could be you have some insight in stocks you're picking, or you have an exceptionally good fund manager, or you have some tactical reason to think they're in a period of outperformance. But I wouldn't diversify foreign just for the sake of it as a matter of permanent investment.
Okay, a question over here, which is when you talked about your high yield strategy, you had a way to get out of the high yield strategy, so trying to preserve capital. Do you have a similar strategy for your U.S. Emerging market strategy so that you're not suffering 50% potential declines?
Right. I mean, that's really the hardest thing we do for our clients is figuring out when to be out of the stock market. And so there's nothing simple that's amenable to a presentation like this. My newsletter does track our main U.S. equity timing model, and I think that would be a good place to start. You would switch between emerging markets or U.S., and if the U.S. equity model is on a sell, then you just be in cash. That would be what I would recommend. There's nothing as simple as what works for high yield corporate bonds.
A throwback to your prior presentation, you had talked about the VIX.
Yes.
And looking at it when it is less than 9 or greater than 19, how often do you monitor the VIX? On a daily, a weekly, a monthly basis?
Well, you should monitor it preferably daily, especially in the environment we're in now, where VIX spends most of its time below 19. So if you monitor it daily, that will. It doesn't stay in today's climate. It doesn't stay above 19 very, very long. So if you monitor it only on the monthly options expiration cycle, the odds are you'll miss some entry opportunities. So I would recommend monitoring it daily. Open the position for an option lasting anywhere between 2 and 6 weeks. So either the near month option or the one following that, and then ride that out. That's the approach I would recommend. You really should monitor it daily, because the spikes in VIX that generate the big entry opportunities don't hang around for that many days.
Okay, thank you very much.
Thank you very much.
One comment on our website, we're going to be placing the list of investment books that we keep at the back so that you can actually use that as a source of references. And let's give a warm thanks to Marvin, and thanks for coming out to California.